All right, it's time now for Word of the Day, where I break down a financial term or concept for our very smart viewer, but just perhaps not the financial expert, not the Dean Baker in the audience. And today it is financial transaction tax. And I want to talk about this because we're going to get into it with our guests later in the show. But I first want to break it down a little bit for you. And it's being talked about in this instance. Here is Roger Cohen recently in the New York Times saying this in his story. Some ideas like the Tobin tax on global financial transactions have been around for years, but they are almost impossible to apply. Now, to which Dean Baker responded to the Cohen story in a post saying this. He wouldn't say this if he was familiar with the United Kingdom. The United Kingdom has been taxing trades of stock for centuries. So first, let's look at exactly what is the definition of a financial transaction tax. It is this. It is a tax placed on a specific type of financial transaction for a specific purpose. This term has been most commonly associated with the financial sector as opposed to consumption taxes paid by consumers. Now, examples of places that have one, because there are countries that have them. So as Dean Baker referred to, the UK has taxed UK stock trades for centuries. It's called the stamp duty there. Other countries, Singapore has a 0.2% stamp duty on transactions of stocks and shares. Also, Switzerland has a transfer tax levied on securities, where one of the parties is a Swiss broker. And even there was one in the United States from 1914 to 1966 on stock sales and transfers. Now, this has been an ongoing debate in global policy. A proposal for a financial transaction tax at the G20 in November failed. Later that month, though, you heard the European Commission president saying that one of these taxes remained a possibility between Eurozone countries. And before that, France and Germany have been championing a financial transaction tax. Now, as Dean Baker referred to, the United States has not backed this. They wouldn't back it at the G20, reportedly worried about the burden on banks. And some advocates of this say that Timothy Geithner has effectively vetoed it. Now, some arguments against this are that volume will drop and trading will move to countries where there isn't a tax. Arguments for it include that it could raise revenue. Studies show for the U.S. it could mean $100 billion a year to fight the deficit, create jobs, or whatever other purposes that it was designed for. So we will get more into this, but now you know the basics of a financial transaction tax.